I'm talking to you today from Aviva's digital garage here in Shoreditch in London. It's an innovative place that's building a new business, and it really is exciting. With Aviva's results today, we've seen a trend of stability and growth amongst a backdrop of market volatility, foreign exchange headwinds, some of the worst floods we've seen here in the UK in the last 100 years. What we've seen is actually growth in all our key metrics, all moving in the right direction. So for example, we've seen operating profit up 20% to £2.7 billion. We've seen value of new business, our core measure of life sales, that's up 24. And you know, in that measure, that's now 12 consecutive quarters of growth. I think that's a lot of consistency of growth and results. Our combined ratio, which is our key measure for our general insurance business, that's 94.6%. And that figure's, in fact, our best combined ratio now for 9 years. So that's a pretty good result from our GI colleagues. And of course, we can't forget Aviva investors. They've just passed £105 million of operating profit. That's an important milestone. And that's a 33% increase on the year before. And their flagship range of funds, that's the AIMS range of funds, it's performed outstandingly in the last 12 months. In fact, since inception, it's outperformed its peers. Now that range of funds now has about £3 billion in it, and that's a very good start. Our dividend follows our half-year trend, and we've put that up 15%. Now, when you consider over the last couple of years, our dividends actually increased 38% over the last 2 years. So we're starting to repay, I think, our investors for their patience with us. So one of the things that's been on investors' minds a lot over the past 12 months is Solvency II. How will insurance companies transition to it? Will they have enough capital? How will it work? We're pretty happy with our outcome. We've ended up at 180%. I think that makes us one of the most strongest and most resilient in the UK market. We're at the top end of our working range, so we've got a fair bit of headroom there. And the interesting thing about it is our solvency position is very resilient. A good example to illustrate that point is over this latest market volatility we've seen, even at the worst part of that volatility, which was in February, our solvency basis would have only dropped about 6 percentage points. 3 years ago, all I heard about was the internal loan, this big problematic monster, £5.8 billion. What were we going to do about it? Was it going to be a drag on cash flow? We put in the target for that of £2.2 billion by the end of 2015. In fact, we got to £1.5 billion, far exceeding our target. And now that's an issue, thankfully, I never have to hear about again. 3 years ago, we had pretty modest levels of capital. We've now tripled it as at the end of 2015. You know, I guess it's a long way from just 3 years ago when we probably had one of the worst balance sheets in the market to today we've probably got one of the best balance sheets in the market. And I think that's a testament to a whole lot of work from a whole lot of people. Another key focus of the group in the last 12 months, of course, has been the integration of Friends Life. Remember, we're only 9 months in. I should remind people why we did it. We did it for compelling financial and strategic reasons. On the financial side, it was about expense synergies, it was about liquidity, it was about capital. On the strategy side, that was also as compelling because we got a whole lot of customers that we can show the much greater range of Aviva products. So it really was a good transaction. And it's been delivering everything we expected and more. A key focus of that, of course, is the expense synergies. And in that, we've so far delivered £168 million out of a total target of 225, about 3/4 of the target. Now, because of that, we've announced today we're going to bring forward our target and deliver it 12 months early at the end of 2016, the end of this year. And I think so far Aviva has delivered everything it said it would do and more. If you look at the UK, remember that's amongst the backdrop of integrating Friends Life. You've seen the value of new business actually increase 29%. Now, of that 29%, you've also seen protection business up strongly. And so those two trends we're pretty happy with. And this is after a year, a bit earlier, where of course we had all the pension changes and pension reforms. I think it shows the resilience of the group and the strength of the franchises when you can overcome all of those headwinds, like regulatory change, and still grow your new business that much. And there's other great performers in the year. It was only a couple of years ago I referred to a couple of our businesses, that's Ireland and Italy, in rather unflattering terms. The reality is they're now behaving in the last 12 months or so a bit more like stars. You've had Italy up in terms of VNB, and you've had Ireland that's done a great job both in terms of VNB and combined ratios and profit. So you've had all the key metrics moving in the right way because those teams have made some hard decisions and some tough calls and now are starting to deliver results. And moving to Asia, we've had some good progress there as well. For example, we've opened a digital garage. Our second sister garage, other than Shoreditch here, is in Singapore, and they've started doing some fine work there. Singapore as a business has had a good year. VNB is up strongly. Remember, this was on the back of the choice we made not to continue with the DBS relationship. So they've broadened their distribution, they've improved their margin on their products, and I think Nish and the team out there are making some good progress. And moving to our general insurance, it was a pretty good year in some pretty trying conditions for general insurance. Our core, our combined ratio, which is a pretty important headline number everyone focuses on, 94.6%. Now that figure is in fact our best combined ratio for the group in 9 years. So that's a pretty satisfactory outcome. Our underwriting profits also up 10%. Remember, that's after we had the floods, some of the worst floods in 100 years in the UK. And I've got to say, how our people responded to those floods was just outstanding. We had 100 people on the ground over Christmas doing what our customers want us to do and looking after them. I've seen what the teams have done. I've spoken to some of these customers. It really was first class. Canada had a very strong year. We didn't have too much weather to contend with there. They've made progress in terms of their pricing and their analytics again, and they've really been the leader in that. And of course, I think one of the highlights for Canada is the deal that we announced recently for Royal Bank of Canada. The RBC is a wonderful franchise. They're the biggest bank in that market, and they're a bank that I think culturally is a very nice fit for us, and they'll be great partners. It adds growth to our business there. It adds scale, and we bring with that the expertise. And I have very high hopes for an important business line in a very important market to us. It's a core business. A lot of people are asking us where we're at in digital. It wasn't until we started up this digital garage here that we got a different type of people in there, and it's a much more fast-paced, dynamic environment. Now, it already has revenues of about £1.3 billion or so, and that's making some good progress. But the reality is that what's important here is going to be the traffic to the My Aviva website, where we can put life insurance, asset management, health insurance, general insurance, all in one place. People only have to put in their details once. It's simple, it's easy, and it's going to be a great deal for the customer. Now, we're still in pilot phase. We're developing, we're piloting, we're testing. It's all very dynamic. But so far, the pilots have been extraordinary. The customer gets a better deal, and our margin also will increase significantly. This is the future of Aviva. This is the future of insurance, and there's very few companies, very few composites that could even try what we're doing. So we've got higher capital, higher liquidity, a much simpler business. We've nearly halved the number of countries we're in to be much more focused. Our profit, as you've seen today, is up. All in all, we've made some very satisfactory progress. But I want Aviva to get a name for continuing to deliver year after year, to be like that Swiss clock I've spoken about so many times before. And I think after 12 consecutive quarters of value and new business growth, I think after beating our cost targets now for quite some time, for a few years now, I think after the ability to prove we can integrate Friends Life, I think the dividend going up 38% in the last couple of years, it's been a long journey. We're nowhere near my vision yet. We still have a long way to go, but I call this a very good start. I think we're entering 2016 from a position of strength, and that's a nice position to be in when you have volatile markets and a lot of uncertainty. We have many levers to pull, whether it's product or geographic or where we put our capital or what we do with expenses. We've got a lot of levers to pull, and we're focused on doing that. But 2016 is about Aviva realising more of its future potential.